Good morning, Facebook. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me today is Phil Davis, who's the CEO of Phil Stock World. And when Phil joins me every couple of weeks on Trade Talks, we like to focus on trading strategies that our audience can actually use. And the concept we're going to look at today are call spreads. And Phil, I think when retail investors look at options trades, when they see multiple legs versus just buying a call or just buying a put, it seems to be a little bit scary for them. But that's really not the case when you're buying call spreads.
No, not at all. In fact, buying naked puts and calls, just a straight call and put, is exactly what we teach you not to do at Phil Stock World. That's a sucker's bet because you're paying a tremendous premium for the position. And what we do is we sort of flip that model because I think you might have heard the statistic that like 9 out of 10 options expire worthless. So you're taking a very stacked deck against you when you play options. But there's no penalty for playing the other side of the trade. That would be selling those options to other suckers who think they know what the stock is going to do. And it's funny, but it's true. Because, for example, we were looking at Gilead, which is one of the most underpriced plays on the entire Nasdaq. It's a biotech, it's basically a pharmaceutical company. They have biotech. They buy a lot of little biotech companies. They've got a huge pipeline. They're a very steady revenue earner. They pay a dividend, but we're going to skip the dividend. And you can buy this stock, which is $66.25, or it was this morning anyhow. And instead of buying the stock, you can buy a call. You do buy a call, and you buy the 2019, so it expires in 2019 in January, the $60 call, and that was $11.75. So you're paying net $71.75 because you're paying $60 for the strike and $11.75 for the call. So you would have to have it over $71.75 to make money. But you then turn around and sell the $70 call, the speculative call, to somebody else. That person, the 2019 $70 call, is $7.30. The net of that spread is $4.45. So now, instead of paying $11.75 for the $60 call, you've paid $4.75 for the $60 call, and you're capped at $70 for your gains because you've sold the gains above $70 to somebody else. But that's fine because now your net on the stock is $64.30. All right, so if you're paying $64.30 for the stock for the Gilead, it's at $66.25. So you got a $2 discount right off the bat just for buying the spread. Then as Gilead goes up, you're going to make every single penny up to 70 of the gain. And the best thing is you're only laying out, if you do 10 contracts, let's say, instead of buying $66,000 worth of stuff, you're buying a $4,000 spread, and you have the same upside control all the way to $70.
And I think that's what retail investors have to understand about spreads, whether it's put or call spreads. Yes, your gain is capped, but your downside is also known. So your risk is known from the outset, and that it allows you to manage your portfolio and your P&L much more efficiently because you know exactly what your parameters are.
Yes, it's a little harder. The only downside really to this kind of spread, there's another upside which we can talk about. The big downside to the spread is you can't really get out early. If Gilead really pops, unless it's way up and you can cash the spread out near your full price. But if it just takes a normal move to 75 or 76 or something, you can't get out early with a profit because your short caller that you sold, he makes money too. So your net is not very good until you get close to the expiration. But because the differential between the calls you buy, the $60 calls you buy and the 70 calls you sell, it has what they call a delta. In other words, it's going to change about maybe 50 cents or 40 cents for each dollar Gilead moves. The best thing about that is that means that you actually lose less money if Gilead goes down than if you own the stock. So if Gilead goes down $10, you're only going to lose $4.
Right.
All right. So it's better going up. It's better going down. It costs you 1/10 as much to lay out. And it makes the same money up to your cap limit, which would be 70 in this case.
Well, let me ask you a question, because this is a little bit longer dated. We're out to 2019 on this. Would you still manage the trade the same in terms of what you're comfortable getting in or out of if it was, let's say, more near dated to June or July, for example?
You can do near dated ones. The two examples I have today, I have one other example we can use.
Right.
But the two I have today are long dated. And frankly, I prefer the long dated ones because let me tell you something. This trade makes 112% in 2 years.
You're not going to beat that.
You're not.
For the most part.
If you're gambling, you might get lucky, you might get unlucky, but this is all you're betting is the Gilead, which is a great company that's very underpriced, currently at 66, goes to 70, makes $4, 8% over the next 2 years. That's all you're betting.
Right.
And it makes if it makes 8%, you make 112%.
So this is something that you would plan to hold for the life
Yeah.
of the trade.
You know, I bet, although I bet we'll be back together in a couple of weeks. I bet in a
Right.
couple of weeks it's up 10%. So if you want to make 10% in 2 weeks, you can do this spread too.
Right.
But shorter term, I will look next time for a shorter term trade. But usually you want to have a catalyst like earnings or some event that's going to trigger that you're going to hit your target. And those are always much more dicey than just betting on the long-term value of a great stock.
Right, well, because you have the volatility event in the middle of that holding period, that's certainly going to move the premium around. But let me ask you a question. I know a lot of traders, if they make, let's say, 30 to 40% on the upside, they're down 20% on the downside. Those are those risk parameters that they strictly stick to. Is trading at Phil Stock World, do you manage it the same way, or do you kind of let it go for max profit because they are longer dated? What are some of your risk parameters like?
Well, if something is up early, well, first of all right, I'm going to make, on this Gilead trade, my plan is to make, my trading plan, which you should always have a trading plan, you should always know why you're in a trade and why you're getting out of a trade. My trading plan on Gilead is that we're going to make 110% over the next 20 months. So we should make 5% a month. So every month I should make 5%, 5%, 5%, 5% steady for the next 2 years. Now, should we end up being up 30% in 2 months,
Right.
we're way ahead of the curve. And then we have to evaluate and say, well, wait a minute now, because now it's a different bet, because now we're betting our profit on the 70% return. Now we're betting 130% of our original on what's now a 70% return of what we have. So the risk factor changes, and you have to constantly evaluate that. So yeah, we do at times get out early, but on the other hand, though, again, it goes back to if the fundamentals didn't change, like the net on the Gilead trade is about $4,400, right? So you're laying out $4,400, you're going to make $5,600 if the trade goes well. So let's say I'm at $5,500, and now I'm going to make $4,500 going forward. I still don't have that many better ways to make $4,500 off of $5,500. When you get to 6,000, you're going to make 4,000. When you get to 7,000, you're going to make 3,000. Now, but at the time I'm at 7,000, if I still have a year to go and I'm only going to make $3,000,
Right.
I have better ways to make money than that. I can make new trades. Now, so of course, so what we do is we earmark that for a sell, and then we look for another trade where we'll make 100% instead of 50%, and we might move to that.
All right. Well, thank you very much for joining us at the Nasdaq Market Site. I'm looking forward to the next one. Perhaps we'll focus on put spreads next time.
Okay.
Same strategy, just different type of fundamental
Different. I
philosophy.
would get people comfortable with call spreads first, though, I think,
Well,
before we flip it.
you have to keep things interesting. What can I say? Thank you very much, Phil, for joining us as always on Facebook. Thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.